Well, hello and welcome to the Lending Podcast. We are your hosts. This is JB, infamous guru of mortgage, and I'm Jeff Jones, coming to you from Austin, Texas. And today's podcast is going to be about a market update here, September 2024, and we're going to kind of move that into if you should buy down your rate now or if you should not. So, based on what's going on in our market.
That's right. So many questions we get about how to get the lowest interest rate, how to get the lowest payment, and one function of that is to pay what's typically called a point or buy down points, which is a percentage of the loan amount, and it's a permanent buy down to lower your interest rate, which lowers your payment, obviously lowers the amount of interest you pay over time. And so there's a math equation there of whether or not to pay points, to pay those additional closing costs, to buy those interest rates down. And it's really different for every client. Every situation, as we say, is unique. However, conceptually, we're going to talk about the timing right now and really why you should or should not consider that rate buy down.
That's right. That's right. So let's talk a little bit. I like starting with where the market is and where we think it's going.
Yeah.
So where it has been, where it is, and where it's going. So as we sit, today in this little office, we had a report out of unemployment, and that's affecting our rates. We had the JOLTS report, which was basically how many new open positions were, how many people left their positions. And so this week has been about employment, and then we are going to be having some other good information down the road with September. September is when a lot of people are expecting rate cuts by the federal government. And that does not mean a rate cut on your mortgage rate, but what the federal government is doing on the prime rate. So where do we see, if we're sitting today, the national average of a 30-year mortgage is 6.38?
Yes.
Where we were in the middle of early summer was in the sevens. Where we were at the beginning of the year was 6.6. Where we were right before that last October, 12 months ago, we are just climbing to the 8. So we've had this huge roller coaster, right? We've had this huge, fast, steady increase all the way to 8 over the last 2023, dropped to starting the year at 6.6, and then we've made our way back pretty much to that point now over the course of the last 9 months. So we did this huge curve. So now we're sitting at this point. Where do we see them going?
Yeah, so that's the question that certainly we get all the time. And I think a function of that question is, should I wait?
Right.
Should I wait to buy? Should I wait to refinance? If I'm going to do it now, do I go ahead and get a lower interest rate by paying additional, or maybe take that average rate, that's 6.3, 6.4, somewhere in that neighborhood? And of course, that's an average, right? So there's based on loan type, it's based on property type, it's based on credit score, how much you're putting down. So many factors go into that national average. But those averages are important because it shows the trending.
Right.
And so week over week, what I thought was interesting is we're actually the exact same today as we were 1 week ago. But of course, as we trend downward, right, the headlines are rates have gone down. Well,
Right.
That may have only been 0.01 or 0.02. That's not moving the needle, 50 cents a month on your payment, right? Or something. So it's super, super negligible. But over time, we get enough of those 0.02s in a row, 4 or 5 weeks in a row, 10 weeks in a row, then we start really moving the needle. And that's what's happened, to your point, from early summer. We're better than we were at the very beginning of the year, but just in the last couple of weeks have we gone down enough to eclipse that earlier in the year mark. So taking a half a step back, let's again define what a point is and how that relates to other transaction costs, because it is an isolated break-even analysis, as we say. It's sort of an isolated cost specific to the rate. Now, something else we've talked about on the show before is that interest rates do not move, okay? Interest rates on a daily basis do not move. What moves is the cost to obtain that interest rate. So the rate yesterday could have been 6.3, today it's 6.3, tomorrow it's 6.3, but the intraday and the day-by-day cost differential changes. Yesterday, it might have been a par rate and you didn't have any extra closing costs to buy the rate down. Today, that rate may be 6.3, but it might cost $300 to get that rate because it changed slightly. The cost changed. And so if we identify what a point is, what a closing cost discount point is, it is a one-time closing cost that you pay to lower the interest rate, right? Permanently.
Mhm.
So $400,000 loan, 1% of 400,000 is $4,000. We do an analysis with you to say that $4,000 is going to yield you some number of reduced payment on a monthly basis.
Right.
Let's just say it's $200 a month.
Right.
So you pay the $4,000, you save $200 a month. Everybody likes the lower payment. We do a quick analysis and find out that it's going to take you 20 months, right? $200 a month times 20 months equals $4,000.
Right.
Less than 2 years, you're getting your money back. That's $2,400 a year savings, $200 a month. And so that's the equation that we run. And there's just so many different reasons that you would or wouldn't do that, right? So that's
Yeah.
what we're going to dive into.
Yeah, and that's good. I like that analysis of the return on your investment. We talk about that one, and we call it really a break even a lot of times. So when we say return on investment, break even, that's the same math. So the variables in that are going to be basically what's your time frame that when you're buying your house today, how long do you think you might be there? You know, and then what's your monthly budget? What do you qualify for? How much money do you have to buy down that rate? Or are there seller concessions or other incentives like down payment assistance or other things that are going to help offset cash to close? And then basically what makes sense on the equation. So when we do those intakes with you, we go through a scenario to do your pre-approval. But then once you're under contract, we get really specific with this is what I'm going to put the loan estimate together for you on. Are you comfortable with this monthly payment, this much cash to close? How much cash do you want left over at the end? We love that question.
Mm-hmm.
But the math is like what you said, the return on investment. So it's really a timing question most of the time of like, if it's going to take 20 months to return that buy down, paying that point or whatever it might be, are you good with that? Or do you think you might move or refinance in the next year? And here's the reasons why.
That's right.
So that is the right conversation to have with your lender. So if you're talking to a lender out there, you're a home buyer and you're talking to a lender like, oh no, we make sure we always do a buy down on all of our loans. You don't have to. So there's other options out there.
That's true.
If that's not your scenario that fits best for you, is to do a buy down, then don't go with a lender that's going to make you do a buy down.
Yeah. It's a balancing act with
Right.
the lowest possible payment, with the lowest possible amount of cash out of pocket, the least amount of closing costs,
Right.
all those things that we've said before. We're consumers too. So we're looking at that cost perspective through the eyes of our clients. And I'm going to come back to refinancing and whether or not
Yeah.
you pay points on refinances in a minute. But let's dive in more on the purchase side. So what you touched on is you're buying a home and we're now under contract. We're locking in your interest rate. And as we touched on, the interest rates don't necessarily move on a daily basis. The cost to obtain the rates is what changes. That's what changes consumer behavior. And that's why rate averages go up and down, because the averages are quoted rates. They're not what clients are closing on their house. They're not
That's
the
right.
rates from closing. They're what's being quoted. And so as the pricing of the loan changes, it becomes more expensive, it becomes less expensive. Each lender displays their rate averages differently based on the cost to obtain a certain rate, right? So as a home buyer, we're under contract, we're looking at locking the interest rate. What does that process look like? Well, we're going to show you all the different rate options. And I'll be honest, the rates right now are anywhere from 4.25% to 8%, and anywhere
Right.
in between. So that's like 30 different interest rates that you could technically choose from.
Yeah, and I need to put this out there because in our industry, there's a huge misunderstanding that the rate you get from your lender is kind of a guide to how good that lender was, right? So some people will say, "Well, my lender got me a 5.99. Why did you get a 6.5? You got a terrible lender." Well, that's not the truth. So what you need to evaluate from lender to lender, if you're shopping, and if you are, we got a great podcast on it. So feel free to go through that one. I can't see it. It's number 29.
How to choose your lender.
Yeah, shopping your lender. Excuse me. But basically what we're talking about is maybe a 6.25 is better for you than a 5.75 right now, because your scenario, you want the cash to close and use that money for something else that will actually, or maybe the return on investment is 3 years, and that's a ridiculous time to wait when you think you're going to refinance in 2 years.
That's right.
So don't do that. So you actually will have a lender that may give you advice that is more harmful for your scenario than a lender that's giving you a higher rate.
Yep.
So
Let's
that might blow up some people's minds. What? A
yeah,
higher rate might be better for me? Yes, it might
absolutely.
be.
Yeah, let's use an example from yesterday. So I'm
Yeah.
working with a client right now, same very similar scenario. So they're just under contract. We're locking in their interest rate. And so yesterday's conversation was what rate works the best for them. And again, we know everybody wants the lowest rate. Of
Yeah.
course we want the lowest rate because we want to pay the least amount. Nobody wants to pay more for something than they have to. However, the lowest rate is the most expensive. So where is the balancing act? What is the equation to say, yes, I'm going to pay a little bit extra to get that lower rate, or no, I'm going to take that lower cost option, but it's still a good interest rate. So here's the math from yesterday. So it's a $700,000 mortgage, okay? And the interest rate options, let's just say we had 5.99, 6.25, 6.5. Okay, I don't exactly remember the costs associated, but roughly it was 6.5 was going to cost 0 points. We call that par when you're not paying any additional
Mm-hmm.
for the buy down. Okay, 6.25 was costing roughly 0.5%. So 0.5% of the loan amount is $3,500. $700,000 loan times 0.5%, 3,500. And then the 599 rate was 1% buy down cost, or 1% or 1 point, right? 1%, $7,000 in costs. Now, what do you get for that 1% buy down? Well, the delta, the difference between 6.5 and 599, which is basically 6%, right? Rate. It just looks better. It's like gasoline at 299
5.99.
versus 301.
Yeah,
It's
it's
like
got a
the
five
two.
in front of it.
Yeah, exactly. And gas is always 299.9. So really, it's three.
Yeah.
It's 1 penny different. But anyway, we all gravitate to the gas prices, right? Well, that's what happens with interest rates too, and it's visual, right? So 599 versus 6.5. 0.5 percentage point on a $700,000 mortgage is roughly about $3,500 a year. That's roughly $300 a month. So, should this client pay the $7,000 to save $300 a month? It's roughly a 2-year break even.
Right.
Normally, in many markets, I would say that's a fair buy down. Let's do the 599, pay the $7,000. You're saving $300 a month. That's a high five, smiley face. Okay.
Right.
However, when we're in a decreasing rate environment, does it make sense to pay that point and get the 599, or we got to close on the house because it's closing in 30 days, right? So we're not going to wait around for interest rates in the next couple of weeks because there's probably not going to be significant movement in 2 to 3 weeks, and so we go ahead and take a 6.5 rate. And this is a question they're still pondering this right decision, and my guess is they'll probably do the 599 and pay the point to get the payment down. But the question is, should they, right? Because if they do the 6.5, save the $7,000, what if rates are 5.25 in the spring? They will have not paid that. Would have saved that 7,000. Now we do a refinance in the spring, drop them 1.25, and now their payment's a lot less. So that's I know I got specific there with
so
numbers.
just recap that math real quick, since it's a good example, right? You're basically going from a 6.5 costing nothing for the buy down, because you're not buying anything down, and say you go to the 599, that's costing a point. You have a 2-year break even.
Right.
If you do not refinance in 2 years, they are the same loan. After that, the 5.99 starts saving you money. Okay. So if you're going to keep that 599 for longer than 2 years, it's a very smart move because you're saving money every month after that. So you want that buy down. If you're going to refinance in a year, you just spent $3,500 you didn't need to spend, right?
Right.
That's
for a title policy and appraisal. And
right.
And that's another topic is how much does it cost to refinance? It does depend. It depends on a lot of factors. The title policy, the appraisal, the closing fees at the title policy.
So one of the great conversations we have about timing is, if we're going to refinance in a year, let's get you that best loan for that time frame. right?
Yes.
Or if you're going to refinance in 2 years, or you're going to move in 3 years, let's get you that rate for
Hmm.
that time frame, if that makes sense,
That's right.
right? So it's almost like when you're talking buy downs, because we're going under contract, you're going to be moving into the home, 30 days. What rate should we lock in? Because we
Hmm.
have to lock rates, right? Um, we don't want to flip them all the time, especially right now. There's so much volatility, but we want to lock you in. And so when we lock you in, we have to have that conversation. Otherwise, we're doing you a disservice as a buyer that we don't know your timing of what makes sense financially for you.
Yeah, and let's define what a lock is. A lock
Yeah.
is a promise. A lock is a two-way promise. We're actually promising to deliver the loan to the investor because we're going to close it, we're going to fund it, you get the keys, we're going to transfer the servicing. It's not necessarily selling the loan. All loans, for the most part, are pre-sold.
Right.
They're pre-sold to Fannie Mae or Freddie Mac or Ginnie Mae, which is FHA or VA.
Hmm.
So we've already determined that the loan is going to be purchased by Fannie Mae or Freddie Mac, let's say it's a conventional loan, um, whether or not we service the loan, all banks, for the most part, most mortgage companies are in the same boat. They may be able to service, but they might not choose to service the loan, which is taking your payments. So we lock an interest rate. We're promising the loan to the investor, and then we're promising the terms to the client, right? So it's a two-way promise. What we're not doing, if we float, we're not guaranteeing an interest rate to you, the client, and we're not guaranteeing that the loan's going to be sold at a certain price to the investor. So we're floating with the market. We're on an inner tube on a raft in the middle of the ocean, waiting for the waves to take us whichever way, right or left, up or down. So I'm always a lock bias for the most part, in 99% of the time.
Most loan officers are.
Yes, and that's because I enjoy a little bit of gambling, I will admit, but I don't gamble with your money, right? I'm not going to gamble with my client's money. So let's get the loan locked, have the peace of mind, have the clarity, and lock in the price of the loan. Again, because the price is what changes on a daily basis.
Yeah.
And so by locking, we're locking the fees, we're locking the rate for a certain amount of days. Usually we do 45 days, even though we're closing a lot faster than 45, but it's just extra cushion for, perhaps a seller can't close on time and they have a delay. So there's things that are a little bit out of our control occasionally. So I like to have some cushion on that lock. We didn't get into this thinking we were going to talk about locks, but I wanted to talk about
It's
because
good. It's
because
good.
when we do the lock, that's when we're promising and that's when we're
Yeah.
delivering the terms and clarity to you as a client exactly what you're getting for your choice that you made. And let's back up a half a step. This locking a loan and choosing a loan, locking a rate, it should be a a choice for our
Hmm.
clients, and it is every time we present options. Our clients review those options, look at the break-even analysis, look at the cash out of pocket. Let's look at the payment. Let's look at the cash. These
Right.
are the two checks you're going to write at closing, right? We talk about all the time: the check for how much your mortgage payment's going to be, and the check for how much cash you need at closing. So everything revolves around those two checks that you're going to write at closing.
Hmm.
Yeah. So choosing your loan is super important. Locking your interest rate, we believe, is important, even in a downward trending rate environment. Why? Because if you're working with a lender who has the same ability that we do, we can renegotiate your loan terms lower if rates go down while we're locked. Ask your other lender if they can do that. It's really important to know that if I lock in at 6% and rates go to 5.5 before closing, can my lender get me as close to that 5.5 as possible? And the answer
Yeah.
is there's a process for that, but not all lenders offer it.
Yeah. And the process is different for every company, just so you know.
That's right.
So people need to know like what one person here at Benchmark might tell you about how we do it. It's going to be different at another shop. It really
Yeah.
is. And that's how our industry works because they have agreements with their secondary buyers out there in the market of how that works, right?
Mm-hmm.
And there's costs associated with it. So it's usually never free. It might be something the branch absorbs, or it might be something we pass on to the buyer. As long as it financially makes sense,
Yep.
you do it. If it doesn't financially make sense, it's like, no, we're fine. We're good with what we have. But all that to say is a little look behind the curtain is those options are available. They're not available with every lender, and every lender deals with that differently when you
Mm-hmm.
change your lock rate.
Yep. Okay, I want to circle back to
Good.
refinancing. Okay, so right now we're working with several clients, dozens, that are in that 7.5% to 8% range on their interest rate. They
Hmm.
bought in maybe the fall of 2023. That's just what rates were. They were in the 7.99 range, 7.625 range, somewhere in there. And so now with an average at 6.3, we've done some quick math. That's 1.5 percentage points of drop in rate.
Mm.
Let's take that on a $400,000 loan. That is $6,000 a year in interest. So $500 a month. So let me ask this question. If a refinance costs you $3,000 and you're going to save $500 a month, how many months will it take you to break even? 6. That is a no-brainer. In my professional
That's
opinion, that is a no-brainer.
super
Even
good.
even if rates drop again, guess what? 6 months later, do the refinance again. So I'm having clients review their 7.6 loans to go to 6.6 or 6.125 or whatever the delta is that makes sense. Minimize those closing costs. We're not doing a lot of points buy down on these refinances because we are trending downward
Yeah.
already. Now, if you choose to take a par rate, you're saving the cash up front. You're still getting a great break even on your refinance, probably less than 12 months. And now you're not heavily invested in the cost of the refinance. I think that's what really concerns a lot of folks. Well, maybe I should just wait until the rates hit the bottom. Not necessarily. Just be very cautious of investing too
Yeah.
much in the refinance. Don't roll in $10,000 or $15,000 into your loan unnecessarily. Minimize the costs, get a lower interest rate, lower the payment, then watch the market and do it again in 6 to 12 months.
Yeah, and since we're doing a market update and time stamping this, I love what you said. I want to throw out another option out there. If you are out there and you have a interest rate in the sevens that starts with a seven in front of it, this might be a good time for you to talk to your favorite lender. Hopefully, that's us about what are my options to refi now, and please also look at the 20-year pricing. So what we're seeing right now with people that have rates in the sevens, when we look at the 20-year, moving them from a 30-year mortgage to a 20-year mortgage with today's rates, with what the 20 years are costing, it's basically a pretty quick break even. And then once that break even happens, you're building your equity so much faster because you're compressing it down. You're taking 10 years off your loan for once. Most of the scenarios we're seeing right now is your monthly payment is virtually almost the same, like within $10 a month difference. So your monthly payment doesn't change because you're getting a much better rate on a 20-year mortgage. You're building your equity faster, and we have the numbers that show, like, one scenario, over the life of your loan, you're going to save $100,000 in interest, or over the life of the loan, you're going to save $150,000 or $200,000 in interest. So if you can start saving those $200, $300, $400 a month in interest now, then it might be a good time for you to refinance and do a 20-year mortgage.
That's right. I'm going to give you another real life example on that exact topic. So I have a client, their mortgage balance is $660,000. Okay. If your mortgage balance is 330, just cut these numbers in half, right?
Right.
But 660,000, interest rate right now is 7.5. We're going from 7.5 to 5.625 on a 20-year. So almost 2% difference. They bought the house in 2023. It's 1 year later. So they have 29 years left on their loan. We're going to take them from a 29 years left situation to a 20-year fixed. Their payment savings over the life of the loan is $494,000.
So payment savings over the life of the loan. So when we're looking at
Interest
amortization table, what your total payout is, your balance plus your interest, they're going to be saving over
94,000 because their payment
$494,000.
is over $4,000 a month. I think it's almost $5,000 a month.
Oh my
Times 12
gosh.
months is 60 grand a year. Times 9 is 540, but it's
Oh
just
my
less. Their
gosh.
payment's like 4,600 a month. So when you take $4,500 a month off of your mortgage for 9 years, that is 108 months times $4,500. That's how much savings it is. Like
That's crazy.
going from a 30 to a 20 year, and it is incredible. And we have so many clients. I can't even count on the number of times we're at the closing table.
Mm-hmm.
They haven't even made a mortgage payment yet, and they're asking me at the mortgage at the closing, how do I do, like, I've heard that I could do biweekly payments, or if I add a
Okay.
payment,
Yep.
because they get their amortization schedule and like, oh my gosh, I'm going to pay this thing off in 30 years. How do I pay it off sooner? Well, you could do two ways. Obviously, you could just pay more per month. You could also switch your term, and like we're talking about with this 20-year, it forces you to make the 20-year payment.
Right.
I like that. If you can do it with your budget, strongly consider it. If you can't do it with your budget, then just add something to your
Whenever
mortgage
you can.
when you can.
Hmm.
Yeah. And that specific example, so cut that in half. If it's a $330,000 mortgage, they're going to save almost 250 grand over the life of the
Yeah.
loan.
To go from the 7.5 to
Seven and a
five
half
and a
to
half.
five and a half. Yeah.
Yeah.
Which of those
5.65.
rates are out there?
They are.
And they're okay. And so then I get the question, well, how much are the closing costs? Okay. Does it really matter? Because you're saving 494,000. No, I'm kidding. I mean, the closing costs,
It
I
didn't
think, were
matter.
about 10,
Yeah.
10 grand, right?
Mhm.
But yeah, so there are some closing costs there. But if
Yeah.
you lay it in front of your financial advisor and say, should I pay 10,000 to save 490,000? That's
Yeah.
a 10 out of 10. Yes.
Right.
Yes, you should do. So let's not always look at what are the costs. Let's look at also what is the benefit. And that's what we do. That's the analysis we present to you.
Hmm.
Yeah.
I like
So,
it.
yeah. To pay points or not to pay points?
To pay or
That
not
is
to
the
pay?
question.
That is what's on my head.
That's right.
Okay. Thank you so much for tuning into the Lending Podcast. We appreciate you out there. If you're listening, please like, subscribe. Please share it too with others you think that this might be good information for to help them with their decisions. And again, we appreciate you.
Thanks so much for being with us. We'll see you next time.
Thank you.